will be recorded so that people that are here can rewatch it, or you can share it with people that weren't able to join the webinar today. But without further ado, I am going to turn things over to Joe so he can get us started.
Thanks, David. We appreciate the opportunity for Bousquet Holstein to participate in their webinar series and to have the opportunity to talk to some of your members today on key issues in the legal space faced by businesses in these really unprecedented times with COVID-19. So just a little bit of background on our law firm. We have 3 offices, Ithaca, Syracuse, and New York City. We have about 45 lawyers spread across various practice areas, and we serve businesses and individuals. The idea, as David said, of today's program is, a lot of folks, including our firm, have spent a lot of time over the last couple months at this point talking at people on various issues, and we thought it would be helpful to provide a town hall forum for folks to ask questions back. And so we've identified a number of subject matter areas that we were planning on focusing today, including employment, tax, SBA loan programs, commercial contracts, landlord-tenant issues, insurance coverage. But of course, any and all questions are welcome. We also have a couple of my colleagues on who focus in succession planning and bankruptcy, and those are issues, of course, that are front of mind for many individuals and businesses in the current environment. The format here is we're going to give brief overviews in each of these areas, and then take questions, and then to keep the program moving, at a certain point we'll cut off the questions, and any overflow can be handled and addressed at the end of the program. So we have a number of my colleagues here on the webinar with me today. In the employment area, we have John Valentino and Micah Ordway addressing tax issues, and also SBA loans is Phil Bousquet, Christy Miso in the tax area. Also on the SBA loans, we have Greg Erickson and Gene Everett. On commercial contracts, my colleague JP Parachos and myself will be available to answer questions. On landlord-tenant issues, we have Josh Werbeck and Bob Weiler, who's a bankruptcy expert. There's some overlay of bankruptcy issues in that context, as well as others. And insurance coverage, Micah Ordway again, and myself on those issues. And then succession planning, my colleague Emily Lawson Hatch is with us. And again, Bob Weiler on bankruptcy issues to the extent they have an overlay in any of these contexts. So I'm going to turn it over to John and Micah to talk about employment issues. Micah and John? I think you're muted.
John, go ahead. Uh-oh, is John, are you there, John?
Let me see, I'm trying to.
Can you hear me now?
There we go.
There you go.
All right, thank you.
Perfect.
Thank you. Good afternoon, everyone. In response to the pandemic, there has been an incredible amount of legislation and regulatory activity in the last 6 to 7 weeks. I'm going to try to briefly summarize some of the legislation in order to give us an opportunity, to give everyone an opportunity to ask questions. First, New York started the ball rolling on March 17th when it enacted a new law that for the first time in New York's history actually required most employers to provide paid sick leave to employees. That law had a very narrow application. It really only applies in the event that an employee was subject to a quarantine order, okay? The law added the usual protections for job protection, requiring that an employer cannot discriminate or retaliate against an employee that requests or needs such leave. The law ended the waiting period for employees to apply for unemployment benefits if an employer closed due to COVID reasons. And in one significant aspect of the law where I've gotten a lot of questions is that an employer can't use this law in place of existing sick leave benefits that have already been provided to the employee. There's more depth to that act, but again, I'll save that for questions if anybody has one or has any. A few weeks later, the federal government stepped in with its own law. You've probably heard of it. It's called the Families First Coronavirus Response Act. It has two major components that deals with labor law issues. One is the Emergency Paid Sick Leave Act. That act not only applies to employees that are subject to a quarantine order, but applies to employees that have been advised by a healthcare professional to self-quarantine due to COVID. It applies also to employees that are just experiencing COVID symptoms and are seeking a medical diagnosis. The law even expanded beyond those employees and allows employees to get paid sick leave when they are caring for an individual who is subject to a quarantine order, or they're caring for a son or a daughter who cannot attend school or a child daycare center because the school or daycare center has been closed due to COVID reasons. And it also applied to other general conditions where employees may suffer conditions which the Department of Health determines are COVID-like. This law applies to most employers that a lot of us represent. It applies to all employers with less than 500 employees. What this law does is give employees the benefit of 80 hours of paid sick leave. For part-time employees, it would depend on an average of their work hours over a 2-week period prior to the COVID epidemic. The difference, most employers, when they heard about this law, they were very concerned about the cost, but what makes the federal law very different than the New York law is the federal law subsidizes the sick pay. Basically, there is a tax credit that is provided to employers that is equal to 100% of the wage benefit that is permitted under the law, which is capped, by the way, at $511 a day for employees taking sick leave due to one of their own health-related reasons, and capped at $200 a day for employees taking the sick leave due to caring for other people, their children or someone else with COVID symptoms. The second major component of this law provided expansion to the Family Medical Leave Act. It had a very narrow application. It really only applies when the employee is unable to work due to the need to care for a child whose school or daycare center has been closed due to, again, COVID reasons. This law does not require any pay in the first 10 days, but if you remember back on the Sick Leave Act, they might get the first 10 days paid for anyways as part of the Paid Sick Leave Act. It also provides for after 10 days, paid sick leave of $200 a day for a maximum of $10,000. Again, the law has the typical job protection provisions. If an employer is a small employer, for instance, less than 50 employees, they may be able to avoid providing this expanded sick leave benefit if they can demonstrate, in accordance with the regulations, that providing that kind of leave would jeopardize the very existence of the business. And lastly, I'll just mention the new unemployment benefits. Many of you have probably read about it. In addition to getting unemployment, if an employee qualifies for it under state law, employees expanded to include independent contractors and the self-employed can now get a benefit of $600 on top of whatever state benefit they may be entitled to. This has created a big problem in my practice for many employers who are finding it difficult to bring employees back because they're making more money on unemployment than they are sometimes earning or were earning on their job. This is particularly an issue for employers who got a PPP loan and who are obligated under the loan in order to obtain forgiveness to have 75% of the loan proceeds apply to the payroll. So, that's a quick summary. I've already taken up a few minutes. I want to leave some time for questions. So please, town hall style, I'd love to get questions. I'm sure Michael would as well. Mike is my partner and practices a lot of labor and employment law with me, along with a practice team that we have. But please, any questions?
Well, I guess I can go. Hi, my name's Erica Ekstrom. I own the Painted Bar Stables. I'm actually in my truck in the middle of a horse field. My question is, I haven't received yet, but it's in process to get a PPP. And I know how it's calculated, paying my employees and this, but I'm not sure how they calculate it in terms of, if I get any pay from that as well. I'm a sole proprietor. I don't give myself a W-2. So I'm not quite sure how they're looking at that. So I guess, I don't know if that question was clear enough, but that's my question.
I might turn that over to the PPP folks, but I'll generally say,
okay,
you can absolutely use the loan proceeds for payroll. So then really your question is, can I include myself in payroll? So
yeah.
Certainly, if you're paying yourself as a W-2 employee, I see no problem with it.
Okay.
Are you paying yourself as a W-2?
I haven't been.
Okay.
That's what kind of how my question is. So they base my PPP off of my net income as well as my payroll.
Hi, Erica. This is Phil Bousquet speaking. So I think I'd have to look at, there is a whole guidance from the SBA on sole proprietors.
Okay.
It's really focused on sole proprietors that don't have employees and how that works, right? So I'd have to look at that. I know that in that case, it is the function of the PPP loan that you can get and that you can get forgiven is based on your income, not on what you actually pay yourself in a check, right? It's your Schedule C income. So I don't think adding employees into the payroll, which certainly expands the eligible amount and the forgiveness amount, should change that metric, but I haven't had to answer that question for anybody yet in real time. So, but the answer I'm sure is in there. I'd be happy to take a look at it offline and move back in with you if you want to.
That would be excellent. I can put my email in the chat so you can have it.
That'd be wonderful.
But basically I'm trying to figure out how to most easy. I mean, worst comes to worst, I just give my employees all the money and that's fine. Like, I'm actually fine with that, but I'm in theory on unemployment. I just haven't received anything. And I know that if you get a PPP, then you have to come off of unemployment as a sole proprietor as well. So, at that point I'm like, okay, so now I'm able to pay my staff, but how do I pay myself? So, how do I make sure that my business is earned? And then we're not going to be really earning money just because they're back to work. So, so I'll give you my email.
Okay. Yeah, that'd be great. Thank you.
Great.
Any other questions?
Jennifer Demarest just posted a question. Jennifer, if you want to unmute yourself, you can ask it now.
Oh, okay. I put it in the chat session, but I realize it's a little vague. I'm wondering how, well, one, if we need to, and how would we go about compensating our employees who are working from home? Not obviously their salary, meaning more like, do we give them something extra from working from home?
Well, certainly there's nothing that I'm aware of, at least in the PPP program, but certainly under labor and employment law, that requires you to pay employees more simply because they're working from home or because they're essential workers. And how you would pay them, in my mind, is you would just continue to pay normal salary. And to the extent, if that salary is under $100,000 and and it's covered by the PPP loan, that what you pay them using PPP loan proceeds will be forgivable. Does that answer your question?
Yes, except one key word I did not hear. It was either is required or is not required.
You mean to pay extra?
Yes.
Like, there is no requirement
Okay,
to
thank
pay
you.
extra.
Okay, if they're, and so I do plan on paying them extra. Is there a metrics or something that could be used? And it's totally fine if there's not. And then second, instead of increasing their salary, could I give it to them in the form of a bonus?
Yeah, you know, I would say that the questions you're asking really just, it's a matter of contract law, and, you know, an employer, you know, you're not obligated to do any of this for them. But on the other hand, if you're looking to bonus them because you feel you have the cash and can afford it, you know, I am here, like, for instance, there is legislation that's being proposed about bonusing monies out to essential workers that are frontline workers. You know, I'm hearing of numbers between 10 and 20%. But again, none of this is mandatory, and you can create what, and you can either do it in the form of a bonus or a temporary payroll increase. I would just be clear with your employees about what you're doing and under what conditions you're doing it, so that there's not some impression, for instance, that it's permanent. Like, the bonus would be discretionary, and the increase to compensation might be discretionary for a specific period of time.
Understood. Thank you very much, John.
Sure. Any other questions?
Actually, I think that's a follow-up to Erica's question earlier when you supplied your email, right, Erica?
I'm not seeing any chat room questions, so I would appreciate it maybe if someone read the question to me.
I think it's the same question.
All right, and otherwise I'd say, please think of more questions, and after we're done with the presentation by everyone, rolling through all the practice groups, come back to me or Micah, and we'd be happy to answer more questions. And of course, happy to answer questions offline, and you can contact us directly if you need to. Thank you.
Right, and so we'll move on to the next subject matter area, but like John said, at the end, if there are any additional questions that you think of in any of the areas, you'll have the opportunity to ask that.
Thank you.
So the next area is tax, and I'll turn it over to Phil and Christy.
Hi, my name is Christy Vori-Misso. I'm going to start out by apologizing. I've got 2 littles at home under 3. So if you hear some in the background, that's what's going on here. And we wanted to give you a little background about some changes in tax and then open it up for some questions. As John just told you about, the FFCRA requires payments for leave, paid sick leave, and paid family leave. And the federal government has sort of made that up by allowing employers to take 100% refundable tax credit against any portion of the employer's employment tax. And this is taken on your regular quarterly return if the amount of credit is more than the amount owed, so you would be due a refund. The IRS has just released a special form that you file with the IRS, so you can get that right away. I mean, right away is sort of a nice way of saying it. It's going to take the IRS some time because they are not at full capacity and they have lots of their centers closed. But they are trying to get advanced payments of those refunds back out so that you can spend them for current operational needs. Another current credit that's out there right now came in with the CARES Act, which is the also what brought us the PPP loans. Under the CARES Act, you can have the employee retention credit. And it's important to note that this credit is only available to taxpayers who did not receive a PPP loan. If you received a PPP loan, you cannot take the employee retention credit. You can take the credit we just mentioned under the FFCRA, the credit that is for paid sick or family leave. Even if you got a PPPL, you can still take the FFCRA credit. However, any day of wages that was for sick or family leave pay that you take a tax credit for, you may not count as your qualified payroll costs for later forgiveness under the PPPL. So they're trying not to give any double benefits of the payroll protection loan and the tax credits for sick leave. The employee retention credit, the one that you can't take if you also took a PPP, is another employer tax credit that is permitted for 50% of the employer taxes. And that is for businesses that have less than 100 full-time employees. They can take that credit for any of their employees working. For businesses that are over 100 employees, they can only take a credit for employees who are not working due to coronavirus reasons. There are some other tax changes that should be really helpful in getting refunds to get money into current operational needs. In particular is the changes to the net operating loss rules. The tax reform of 2017 prohibited NOLs from being carried backwards, but the CARES Act now permits net operating losses to be carried back for 2018, 2018 and 2017. And it also permits, the IRS now permits you to file an extended quick refund claim. So normally a net operating loss, you can file a quicker refund. The IRS calls it a tentative refund claim. And that lets you get that money back for NOLs prior to filing net refund claim for old years. And what the IRS now is going to allow you to do, even though the time period has passed, is file, and in the business we like to call these quick refund claims for 2018. So if you have net operating losses in 2018 and you want to carry them back now to 17, 16, 15, 14, or even 13, because they can go back now 5 years, you can file a Form 1139 and get that money much more quickly than if you were trying to carry those NOLs forward or trying to file a regular claim for refund. There have been a couple of other changes to tax. For individuals, you can now use some of your retirement funds without paying a penalty. There's an above the line charitable deduction. There's been a modification on business expense interest. And if anybody has any questions of those, I'd love to answer them. And I also wanted to mention that while we're discussing tax changes at the federal level, we want to keep an eye on differences between federal and New York, because while New York is a piggyback state, there are certain things that New York hasn't followed with the changes in the CARES Act. So for example, the new business interest deduction, the federal government now allows you to take 50% of your adjusted gross income or up to that amount for an interest deduction. New York State hasn't changed their law, so it's still 30%. And the federal government has also granted basically a very large deferral or extension of time for filing. And that filing counts for returns or entity elections, almost all things you must do for the federal government for related to taxes has been extended till July 15th. I'm going to put a little asterisk there because there's kind of one thing that I am going to point out that they haven't extended that they should. But New York State has not extended the deadline for things like entity elections. So while New York State has extended the deadline for filing of returns for personal and corporate, you still have to keep an eye on when you have to make an entity election, like an S Corp election or an LLC election. And finally, I wanted to point out that the federal government has not yet extended the deadline for when an opportunity fund has to meet its 90% investment requirement. So while the federal government has extended the deadline for an individual with capital gain who would like to invest in an opportunity fund, it has not extended the deadline for that opportunity fund to make its qualified investments. And with that, I'm going to turn it over to Phil to talk a little bit about the tax interaction with the PPPL.
Sure. Thank you, Christy. This is Phil Bousquet. Thank you all for participating. So I'll be very brief on this. We've got a lot to cover still. But there is a tax consequence, of course, to everything we do in our business, and receiving a PPP loan and having a PPP loan forgiveness is no exception. The IRS has just issued a notice stating that in their view, in the Department of Treasury's view, the expenses that are covered by PPP loans that are forgiven, which is principally payroll, rent, mortgage interest expense, and utilities, are no longer deductible because they're essentially being paid with money that that are not includable in your income. There's a little bit of a kerfluffle about this because the leaders of the Senate Finance Committee, Chuck Grassley, and the leader of the House Ways and Means Committee, so we have a bipartisan group in Congress that is saying, hold on a second, that's not what we meant. So the tax consequences of that, depending on whether the congressional view prevails or the administration's view prevails, or how they resolve this question, is going to change the way these PPP loan forgiveness transactions are treated by you on your 2020 tax return. So we don't know yet how that's going to play out. Essentially, if the Treasury's view, if Mnuchin's view, as he's articulated it through the IRS, prevails, the net income, or the net effect, is that there will be no income effect if the forgiveness is subsidizing tax losses you would otherwise have. To the extent that the loan forgiveness creates a windfall, in other words, it's the amount forgiven is beyond a loss that the loan is subsidizing, you would have income in the current year. So that, I think, is what Congress is balking at under the circumstances, and probably rightfully so. This is meant to be a lifeline to businesses. It's not to create and impose additional tax liability. So that remains to be determined. I think we should move on to the next slide, because that's probably, we still have a lot of slides to cover in this presentation. So let's roll forward, unless there are specific questions from the group about tax that we can take now for a second.
Okay.
There being no, go ahead, Joe.
Go ahead, Joe.
Yeah, it looks like we can keep going, Phil and Joe.
Okay.
No new questions have been posted in the chat box.
Okay, so on the SBA loan programs, my colleague Greg Erickson and I are going to discuss these three. I'm going to talk a little bit about the Paycheck Protection Program, and then Greg will take over on the Economic Injury Loan and the Federal Reserve Main Street programs. The Paycheck Protection Program is the program that is getting all of the headlines. The scale of it is absolutely enormous by any stretch of the imagination. The SBA has guaranteed, as of today, over 4.2 million loans. The dollar volume that's out there is somewhere between 425 and 450 billion dollars in loans. So this is just an incredible bureaucratic, nightmare for the SBA, which is used to administering a much smaller volume of this. And the impact of that is that the administration and the compliance aspects of these loans, I think, is going to be, for the large part, for the lion's share of that, is going to be transferred back to the lenders. So your banks are going to be responsible, especially for loans of less than $2 million. Loans more than that are going to be audited by the SBA, but lesser amounts, probably the SBA is going to shift the compliance responsibility onto the lenders. And we don't know how those audits are going to take shape. We don't know what obligations the SBA is going to require of lenders to solicit information from applicants, borrowers, to justify either the amounts that were originally borrowed or amounts that the borrowers are asking to be forgiven under the program. So there is still some money left for PPP loans under the second round of the program. the one thing I really want to mention to those of you that have PPP loans outstanding is to just be very meticulous about your record keeping. Keep track of all of your loan documents, all of the information that you've provided to the bank in the application process, all of the backup behind that information, the payroll information, your payroll reports, whatever you have, the payroll tax filings, any worksheets that you used or your advisors used to help you get those loans. In addition, as you go through the forgiveness process, again, be very meticulous in your record keeping. And as you're administering the loan on your own books, separately account for the loan proceeds. They should be ideally in a separate bank account where you can then create bookkeeping records if you use QuickBooks, in QuickBooks, or whatever your accounting system is. Separately track the money in and out with journal entries so that you have a good, clean record showing exactly what the funds were used for and when. There are two tests that you're going to have to meet. You're going to have to show that 75% of the money that you spend from that account, from that loan, over the 8 weeks after loan closing is spent on payroll costs. Not more than 25% can be for other than payroll costs. And then over the entire life of the loan, if you borrowed money prior to yesterday, essentially, you have until June 30th to spend. You also have a use of funds limitation that requires you to spend at least 75% of the total amount, not just in that 8-week forgiveness period, but the total amount needs to be spent 75% on payroll costs. There's a lot more detail behind all of that. We can talk about that in the Q&A. So I'm going to pause there, turn it over to Greg to talk a little bit about the EIDL and the Main Street programs, and then we'll take a couple of questions before moving on. Thank you.
Hi, everybody. I'm Greg Erickson, and I was going to just piggyback one item onto Phil's presentation before I talk about the EIDL. There have been some statements from the Treasury Department in the last week or so in terms of the audits that may be coming up on PPP recipients. One of the other items that I think we're anticipating may be looked into will be the certification of financial need that PPP applicants made in their application. We anticipate that some portion of audits that are coming up will involve an inquiry into what the specific financial need of a particular applicant was, what types of losses the applicant was anticipating. So to the extent that any PPC recipients can document their frame of mind and their anticipated losses, that would be tremendously helpful going into any audit. Following that, the EIDL is the other primary SBA lending program that was revamped after COVID-19 pandemic began. And I say revamped because it was an existing program. It had been established years earlier. The program was originally developed to respond to businesses that have been harmed by disasters, but mostly natural disasters. So think a hardware store that gets hit in Hurricane Katrina. The EIDL program is a loan program that is there to fill in any gaps in finances that are necessary to make a small business whole after it sustains damages in an emergency type event like a hurricane, tornado, something like that. What occurred for COVID-19 is that this program was opened up to many other different types of entities, and a lot of the restrictions in terms of getting those loans were reduced. Just to go through them briefly, the loans carry with them, these are not forgivable loans. Unlike the PPP, these do have to be paid back. It's on a 30-year term, 3.75% interest rate for businesses, 2.75% for not-for-profits. Many of the barriers that had previously existed for receiving EIDL funds were waived, such as personal guarantees for loans up to $200,000, requirement that a business be in business for a year prior to the emergency. So the point of this was to get as much money out the door as quickly as possible, like the PPP. This program was not funded nearly to the same degree that the PPP has been funded. The first round of funding ran out relatively quickly. There was a second round of funding. That has not run out yet. However, at this point in time, the program is restricted to agricultural businesses only. I believe the latest round of funding, they received $60 billion. But at this point, it's for agricultural businesses only, and the loans have been capped at $150,000. So right now, unless you're an agricultural business, this is not really an option. Hopefully more funding does come up for other types of businesses. The only other provision of this program that you might have heard of was the $10,000 grant that any applicant can apply for and receive a grant even if their application is later denied. The grants were up to $10,000. That was since revised down to $10,000, but really $1,000 per employee. So unless you have 10 employees, a company is not eligible for any more thousands of dollars than number of employees that they have by that proportion. Hopefully this gets funded with a little bit more money because it can be a useful program. It permits the expenditure of those funds on things other than paychecks. And that's the primary difference between this and the Paycheck Protection Program. You can use this to pay your workers, but you can also use it to pay for, there's a catch-all provision that permits businesses to use their EIDL money to pay for obligations that cannot be met due to revenue losses. Pretty broad. You can fit a lot of expenditures in there. The EIDL is really that's the loan program that businesses can use to make up for lost revenue, to pay for obligations beyond payroll expenses and rent or mortgage interest. So again, hopefully it gets a little bit more money. As far as the Federal Reserve Main Street Lending Program is concerned, this was put into place very, very recently. We only just got some guidance on this program within the last week. This program is really aimed at larger businesses. Technically, it refers to small and mid-sized businesses. It's sort of a misnomer. It is aimed at businesses of 15,000 employees or fewer and having assets of $5 billion a year or fewer. This is a loan program, 4-year terms. There's amortization of interest and principals deferred for the first year. The loans are not forgivable. The minimum loan is $500,000. So this program is aimed at much larger companies than the EIDL and the PPP are. And that's one that we expect to get more guidance on in the near future, but at this point, it's really reserved for larger businesses.
Greg, so we have a question from Kathleen Clark from the chat box, and her question relating to EIDL grants is, will those grants be considered taxable income?
Let me see. I may have to throw that to the tax people. I know that it is not expected that they be repaid in any way, and I don't believe the statute refers to whether or not they're taxable. I'd be happy to take that offline and.
I'll jump in, Greg. This is Phil. So I believe that unlike the PPP, which has an express exclusion of the forgivable amount from federal gross income, unless the EIDL modifications, speaking to the grant, have an exclusion amount, by default, that would be includable in federal gross income. not great policy, but that would be probably the IRS's position. Or again, they might take the same position they're doing with the forgiveness amounts, that to the extent that it's not includable if you're funding costs that otherwise would be deductible with that $10,000, that deduction would be disallowed, which would more or less have the same, effect. So I think unless there's a statutory provision, which I don't believe there is on the EIDL $10,000 grant, I think it's either going to be includable or the deductions that it funds would be disallowed.
Okay, we also have another question that asks, what numbers should we be looking at to deem whether the PPP loan is necessary? We already have received the PPP loan.
Well, that's a really, really good question. My view is that you need to look at a lot of things. You need to look at your individual business's metrics and to look to see whether there has been a decline in, depending on what your business is, in sales or in purchase orders or in other communications from customers. What kind of communications have you had from your suppliers about the impact of COVID on the supply chain? What is the, if you have industry publications or trade publications, what have they been saying? What were they saying at the time you were heading into the application process about the impact of COVID on your industry? I think you need to take a broad look, roll yourself back in time to the 2 or 3 weeks around the time you made your loan application to see what the risk that COVID was presenting into your business, to your industry, to your market, to your customers, and document as much of that as you can for the file. Because implicit in your application, you made a determination that the economic uncertainty, the risk to your business made the loan necessary for the ongoing sustainability of the business. It's a function really of risk assessment. I'm afraid that when the SBA audits it, that they're going to look back and look at the actual performance after the loan was given to determine whether, the loan was, quote, necessary or not, which really begs the question, because you might not have been able to do what you did in your business if you didn't have the loan and the confidence that, that the loan gave you to keep your employees on board and keep providing goods and services. So there's a little, a risk of a catch-22 depending on how the auditors, view this certification. But I think the best thing you can do really is assess the conditions at the time and document those based on the numbers from your business and from your industry as tightly as possible.
Okay. If there aren't any additional questions, let's move on to commercial contract issues. And I'll turn it over to JP to give an overview. You there, JP?
I see that JP is unmuted. Maybe just give him a second. No JP yet. Is JP's the last section while he gets his mic and stuff together, Joe?
I can go forward with the description.
Okay, and then we'll circle back. I'll message him now offline.
Right. So in terms of commercial contract issues, what we're really talking about here are the concept of force majeure and other excuses that a party to a contract may have not to perform contractual obligations. In essence, without going deep into this issue here before the questions, force majeure is a provision that oftentimes is included in business agreements, and that provision will have certain requirements to declare a force majeure event and be excused for performing And it's very important to look very specifically at the terms of that provision, because the language will vary oftentimes significantly from provision to provision. Some are very broad, where you can declare a force majeure event for essentially anything outside of the party's control that would prevent or hinder or render impracticable the performance. And of course, that standard is going to vary depending on the contractual language. Now, there are other more narrow provisions that, and oftentimes it will be the case, that specific what are called force majeure events will be listed. Things along the lines of acts of God, government actions, sometimes, although not particularly often, pandemics or epidemics will be listed. And some provisions will have a catch-all at the end, which essentially says in anything like these other events that have been listed, or anything else outside of the party's control. And that catch-all is interpreted narrowly in New York State by the courts. And so the only items that are caught are things that are of like kind. Now, if a force majeure provision is not found in a contract, there may be other opportunities for a party to avoid performance and to be excused under doctrines such as frustration of purpose, commercial impracticability if you're selling goods, and that falls under the Uniform Commercial Code, and the doctrine of impossibility. In the context of COVID-19, we've worked with clients who are on both sides of these issues with respect to potential inability to perform under contracts. And within these circumstances, we always recommend that to fully explore the negotiation of a commercial resolution, particularly if you're talking, for example, in a supply chain. You may have a situation where a supplier of yours can't provide the raw materials contracted for, which then impacts your performance up the chain. And so there is an element here of a shared challenge. And so oftentimes there can be contract modifications or new agreements that can be reached that allow you to continue a relationship with a key business partner, and at the same time avoid the risk of loss caused by an event to fall on any one party. Just something else to note, in terms of the enforcement of your contract rights within the context of force majeure and other excuses for non-performance. The key to enforcing your rights is ensuring that you maintain documents that indicate if you're invoking force majeure, your right to do so. So the factual bases to do that. And it's also important to avoid creating bad documents that are not privileged. So where there are conversations or emails that don't involve your legal counsel, it's important to avoid off-the-cuff type of remarks about the real reasons for not being able to perform. For example, economic reasons, which typically under New York state law is not a valid excuse for failing to perform. Typically, whether it's under a force majeure provision or any of these other doctrines that I briefly mentioned. Does anyone have any questions before we move on to the next subject?
Just wanted to let you know, Joe, that I talked to JP and he's ready to try again whenever you are, before we move on.
Okay. I think we are at this point through that section. So if JP has anything to add to what I just said, he can go ahead.
All right, and can people hear me now?
Yeah.
I have no idea what's going on.
Yeah, we can hear you.
We can hear you.
We can hear you.
Wait, I'm on now?
Yes.
Yes.
Oh, geez. Well, hey, thanks. Sorry about that. We had I'm a square electron generator, I guess. I think Joe covered the bases very well there. Joe and I have worked together quite a bit. Again, good afternoon. I'm JP Paratzkos. I'd only want to emphasize 2 points. The first is that anytime you're going to go sort of take a matter to court, the courts are going to be very, they're going to hold a contract to be pretty sacrosanct as an agreement between the parties. So if there is a force majeure clause, it will have to be read very narrowly, and the courts will construe it and apply it very narrowly. And the concept that Joe touched on near the end there, I think is very important, that if there were other reasons for you not to be able to perform, or for another party not to be able to perform, even if there is a force majeure clause, then the courts will not grant force majeure relief. So if there was already economic hardship and everything, and the COVID-19 shutdown has become like oh, thank God it came because I was in trouble anyway, the courts are going to look right through the agreement and say, well, you really can't avail yourself of force majeure because you weren't performing or weren't in a position to perform before. And the other point I just wanted to mention again is in the context of courts taking a look at these things very closely. If you don't have a force majeure clause, the court's not going to read one in, but they may allow other aspects, as Joe mentioned, the impracticability, frustration, or impossibility, but those are even more narrowly construed. So before getting one's hopes up, you'd probably want to do a pretty good review of your situation and circumstances. And we're finding that in many cases, irrespective of what a document says or doesn't say, the faster and doing least additional damage approach is to try and work out the problems between the parties rather than, or before necessarily getting a litigation ball rolling, so to speak. So sorry for the confusion earlier, but if there are any questions, I'm happy to answer them.
Okay, well, if anybody thinks of anything, any additional questions, you can circle back at the end of the presentation when we'll be doing additional Q&A. Next up are landlord-tenant issues with Josh and Bob.
Hi, good afternoon, everyone. I'm Josh Warbeck. I work in our real estate group. I work in Ithaca and in Syracuse. I'll just quickly go over the points, some of the areas that we're monitoring for landlord-tenant and COVID-related issues. You know, at the top of the list is the federal and state eviction moratoriums. They are both applicable through about August 20th right now. That's because New York's was supposed to expire in June 18th, but yesterday Governor Cuomo extended it through August 20th. The federal moratorium applies to residential tenancies only. The state moratorium applies to commercial and residential tenancies. So if you have questions on the moratoriums, I'm happy to dig in on the issues there. Even though there is an eviction moratorium in place, we are helping clients take the steps that they can, landlord clients, to deal with lease breaches right away. You can take some pre-eviction steps, including serving rent demands, lease terminations, and other issues and other steps we can take. There's late fees and late charge moratoriums in effect too for the entire length of the eviction moratoriums. But we are quick to mention that eviction moratorium is not rent forgiveness, at least not yet. There are bills in the federal government and in the state government to forgive rent, but the political support for those bills is tenuous right now. That is not to say that something couldn't come through. Just yesterday or the day before, Governor Cuomo did express some support for some sort of rent relief, maybe a voucher, maybe an expanded voucher program. All of that, everything I've said so far is really helping tenants. There is some relief for landlords. At the federal level, if you're a covered mortgage in a 1 to 4 unit property, you could get up to 360 days deferment on the mortgage payment. And if it's a bit bigger property, a 5+ unit, so even a huge apartment complex could get 90 days deferment on the mortgage payments. At the state level, state regulated residential mortgages, the state regulators are encouraging and requiring the servicers to allow 90-day deferment periods. Last, I'll just mention that we are working with clients, landlords, and tenants to negotiate deals and arrangements that try to address any of the COVID-related problems, including deferred payments, reduced payments, and then ways to make sure that that money is made up at the end. So I'm happy to take questions on all of these issues. I know we're running really short on time, so we'll move forward. Thank you.
Any questions? Okay, I'm going to speak very briefly to give an overview of insurance coverage issues in the COVID-19 environment. And, you know, as many policyholders have seen, insurance companies have attempted to get out in front of what they anticipate to be, and I think rightfully so, an avalanche of particularly business interruption claims by businesses across the country. And what they've been doing is putting out information suggesting that the standard form commercial property policies, including business interruption insurance, don't cover COVID-19, period, hard stop. And what they're trying to do is dissuade policyholders from even giving notice of a claim and pursuing a claim. And what I'd encourage is that policyholders focus closely on their own specific policies and the language therein and their own facts, because there is no one size fits all answer as to whether there's coverage under any insurance policies. And that's not just the case now, it's the case always with respect to all issues. And policyholders would do well to look very closely at the specific coverage grants and exclusions in their own policies, and pay attention to future government developments and increased understanding of the virus itself. And I'll get into why that matters, because there may be additional arguments that can be made for coverage as the factual situation in the litigation situation as to coverage claims develops. And I do want to note very briefly, in New York State, which is one of several states that are pursuing, considering potential legislation to ensure that COVID-19 losses are covered. You know, it's unclear exactly what legislation might actually be enacted and what that legislation would cover. Now, I'm going to focus here just on business interruption insurance in an offshoot of that, which is civil authority coverage. There's various other insurance policies that might afford coverage depending on your circumstances and the nature of potential liabilities or losses that you would have. But in terms of business interruption insurance, what this coverage provides is a recovery of business income losses and other expenses that are sustained as a result of disruptions to your business. Now, typically, the language in the policy is going to state essentially that there has to be a loss or damage to property. So physical loss or damage. And it's important to remember that that is not confined to physical damage to property. The type of losses that you would encounter, for example, if there were a hurricane or if there were an earthquake, the presence of a contaminant or a contagion like COVID-19 could be a sufficient trigger under business interruption policies. And there is a body of case law across the country where courts have found that contamination or the imminent threat of contamination will be sufficient to trigger coverage under under a property policy as the business interruption coverage. And so policyholders should not assume and accept what the positions that insurers are taking. And this is bolstered by the fact that there's growing scientific evidence indicating that COVID-19 will survive on surfaces for several days. And so these are things to pay attention to. In terms of exclusions, we've heard from clients where they've said, well, gee, we have these exclusions in our policy, even they might be specific as to viruses, but they also, there could be pollution or contamination related exclusions. And again, you shouldn't assume as a policyholder that you don't have coverage. And these are often issues that a broker is not going to be sufficiently equipped to answer. They're questions because of their complexity that you'd be well served by addressing them with experienced insurance coverage counsel, because they're very specific and nuanced. So for example, a pollution and contamination exclusion, it may not reach biological contaminants and viruses. It may relate only to chemicals, depending on the language that's used. Also structurally, the language may refer to a discharge or escape, which is a very different mechanism than the type of transmission we're talking about with COVID-19. So again, ways to work around exclusions when you're negotiating with insurers, and it is often a negotiation. Some exclusions deal with bacteria, mold, and pathogens. Again, arguably that refers to a living thing. Well, a virus isn't a living thing. It's a non-cellular strand of DNA. And so these are the type of very nuanced arguments that can be made to overcome some of the kind of blanket denials that insurance companies are putting forward in this current environment. And they're going to be litigated for years, and the landscape will shift, but it's important to be aware of these issues as you think about what insurance assets you might be able to recover. Are there any questions on insurance issues for Micah or I?
I think that what's going to end up happening, Joe, is I think some people have some questions that they would rather, I think we are tiptoeing into some areas that may be a little personal for some of the businesses. And so okay. I think that some people will be reaching out to you guys afterward so that they can have some more one-on-one question time and not put all their like business out there, which I also think is a pretty valid idea to do. Okay. We are talking about, we do tiptoe into some very personal matters for some businesses. So I think that a good thing would be to just know like that everyone's email information can be shared, or maybe if people want to start putting some email information into the comment section, so that way people can make note of it and then they can reach out directly with any questions that they may have. You guys are giving out a ton of great information, but I do see that kind of being the case a little bit.
Yeah, that's fine, David. And however people want to funnel questions to us is just fine. If you want to collect questions and then we can route the individuals to the appropriate person, we can do that. Or if they want to provide email addresses, we can do that. Any way that we can connect people with the subject matter experts and get answers to their questions. Yeah. We don't have a slide here. And this goes to kind of, these are some of the issues that are a bit more sensitive and that people may have questions on. One is succession planning and another is bankruptcy. And I wanted to give my colleagues a chance to give some summary of issues and how they might be able to help if anyone has any questions. And so I'll turn it over first to Emily Lawson-Hatch.
Hi, I'm Emily Lawson-Hatch. When we're talking about succession planning, we're talking about clearly business owners who are interested in either selling their business to a third party or transitioning it to family members or perhaps key employees. It's very possible that, every business owner should be thinking about a succession plan, but I would say that more and more business owners are considering it now, maybe because these events are reminding us of our mortality, but also because some business owners simply don't want to adapt to the changes surrounding us right now, which is completely understandable. And maybe they're saying, I'm ready for a change, and I'm ready for someone to take over. So it's really important if someone is in that position that they talk to professionals that can help them and hold their hands through it. Another note is sometimes business owners don't want to prepare for a succession plan now, but they want to create a succession plan under their estate planning documents, which would include potentially a will, a last will and testament, or a trust, or other documents that can put a plan in place in the event they die before their business has been transitioned. That's all I'm going to say about succession planning because we're running short on time, but feel free to reach out with additional questions. Thank you.
Thanks, Emily. Bob, did you want to note any issues for particular attention in the bankruptcy context?
I think I was listening to your presentation on commercial law and frustration of purpose and the landlord-tenant presentations, and I think it's important to note that the overlay of bankruptcy on the outcome of some of that litigation, it can be very profound. And really, when you look at Chapter 11 and the complexities of bankruptcy, it really is a framework for negotiation. And if somebody has a disadvantageous position in litigation, it doesn't mean that all is lost in the negotiation process, because even the threat of bankruptcy is brings people to the table, because lawyers are very well aware of what can and cannot be accomplished in bankruptcy. I would think that if you have any sort of those issues, they're probably most properly taken offline. But it's important to remember that all of that is kind of can be overcome potentially in bankruptcy, depending on the nature of the issue. So I think just because you think, well, my God, I'm not going to win because I don't really have a frustration of purpose clause, there may be other things that can be done for you and for your position. So you shouldn't necessarily give up just because the law happens to be against you. And I think that's the important point. And you really probably should, if you want to consult with me or with one of our other counsel, it's important basically to know that principle. And so all of the things you've heard about commercial law and landlord-tenant, they could be affected in a bankruptcy case. Joe?
Okay. And so that concludes the portion of the presentation portion of the webinar. I don't know how many people we have left here who are not our Bousquet Holstein folks, but if anybody has any questions, they can feel free to ask them now. Like I had said and David had said, and others, if you have additional questions, please feel free to reach out, and we're happy to address any additional questions offline. And I'd like to thank everyone for participating and attending.
And I'd like to also thank you, David, for hosting this and putting it on, and to thank the Chamber for letting us participate in this. So thank you so much, and thanks to all who attended. Oh,
no worries at all. We appreciate the partnership, the membership. You guys are a great member of the Chamber of Commerce. And again, this is you guys provided a ton of wonderful resources and information. The reality is that we will make this video available on the Chamber website as well as the Chamber's YouTube channel, so that as another webinar in our series. So there will be people that will watch this video that are not here today that will reach out to me. They can reach out to me directly at dwalton@tompkinschamber.org, or you can contact anyone at any of these email addresses that have been provided at the end of the webinar today for any additional questions or resources. Bousquet Holstein and the entire team will be readily available to take any questions that you may have as we all survive and thrive in this pandemic time that we're all facing together. All right. And on that note, I'm gonna go ahead and wrap us up for today. Thank you again for all the presenters and all the information. It was amazing. And just know that the chamber is here for you, and so is Bousquet Holstein. All right, thank you all.
Thank you very much, David.
All right, have a good one.
Yeah, thanks to everyone.